Hello and welcome to this Wednesday's morning market briefing. Got lots to talk about. Firstly, global debt reaches new record highs of $307 trillion. As well as that, the chief economist at the OECD has recommended that interest rates stay higher for longer. And as well as that, we've got lots to talk about on the charts, lots of opportunities, and as well as that, we've got lots of economic data coming out today, which we'll talk about at the end, including the Fed's interest rate decision, and that's having a great impact on the market. But let's get straight into it. So the first article to talk about really is this, and that is that global debt has reached records highs. Now, the global debt pile hit a new high in the first half of this year, and this comes as borrowing as a share of gross domestic product is rising again after nearly 2 years of declines. Now, total debt rose $10 trillion to about $307 trillion in the last 6 months to June. And this comes as, there's been large issues across the globe with, higher interest rates. And we'll come to that in a second, but this is really the large killer for a lot of these, countries at the moment, is having these, rising interest rates and rates reaching highs not seen for decades. And that's having great impacts on their own debt that they need to finance their fiscal year. And so we'll come to that, but ultimately it's interesting to see how this is having such a grave effect on certain economies more than others, and that basically, this debt is going to keep rising as long as rates keep rising. Now, global debt as a share of GDP rose 336% by June this year, with that being 2%, with that being a 2% rise, from the start of this year. Now, that still remains below the peak of 360% during the coronavirus pandemic. If we think back to the coronavirus pandemic, we can sort of remember, the issues to do with debt at that time. Banks and the governments trying to finance, the overwhelming costs of COVID and locking down your country by issuing new bonds and just accumulating more debt. And as we saw then, debt as a percentage of GDP reached 360%, and that was also because GDPs were falling after locking down the nation's economy. But that all culminated in creating such a high percentage rate of debt to GDP. However, that is not as high in terms of the actual monetary value of the debt, which has reached new highs globally today. Now, rising interest rates have been to blame for the rise in debt, as borrowing costs have risen. This could ultimately have long-term implications for countries' funding and their cost dynamics, because obviously a lot of these countries, especially emerging economies, which we'll come to in a second, do rely on financing debt for their fiscal year and for their growth. And these countries which were are looking at potential high growth rates will be limited if they're not able to accumulate that debt the same way that they have before. But yes, and now rising rates will damage developed economies markets the most, with rising rates being a risk to public finances and sovereign ratings, because this is coming to the fact of a lot of countries won't be able to accumulate more debt if rates keep rising, and if the global debt pile continues rising, just simply because people will damage their, well, not people but governments will damage their credit ratings, because they won't be able to finance this debt, and as a result they'll have to refinance their debt, and that comes with a whole new host of problems. So it'll be interesting to see how this is resolved, but also with an even larger debt-related issue. There are even larger debt-related issues on the horizon for emerging economies, because we have to remember, although for developed markets this might be the biggest issue for them, is the rising rates and as a result the rising debt. However, for other developed economies, we also have issues of just lacking infrastructure, issues within the demographics of the nation, the political systems, and so this is just adding on the issues for these developing nations, which are already having a hard time with China's economic issues. But moving on from that, the second article to talk about really is Joe Biden. No, not Joe Biden, sorry. The central banks being warned of interest rates being too low still. And this came as the OECD chief economist told central banks that they should hold interest rates at their current levels or raise them further, actually, to defeat inflation. And this kind of comes as a surprise to us, really, especially after all these days that we've spoken about. Central banks looking at actually reducing rates sooner. A lot of officials, especially within the ECB, we've heard recently, have spoken of this idea of actually coming to the end of their rate hiking cycle very, very soon. And even Andrew Bailey for the Bank of England that said that interest rates are reaching their highs. Now we know the Fed have also said that interest rates are kind of at their highs now, and they're more so looking at keeping rates at the same area that they currently are, but just keeping them there for longer. But so it's kind of surprising to hear this from such a important economist in relation to central banks, but we'll see how that turns out. Now this comes as signs of economic strain caused by higher interest rates have become increasingly more visible. And we've seen that even within China, which we've spoken about a lot recently, but especially in Germany, which is having a great deal of issues within their manufacturing sector to be particular. And they're having lots of issues as a result of these increased borrowing costs. And frankly, most businesses, after living within this cheap money era that we have been in for the past decade, and kind of coming out of that and trying to deal with these extraordinarily high interest rates, is causing a lot of these businesses to struggle, and they don't have the means to deal with them. Now the OECD also stated that it was necessary to see durable progress in defeating inflation before considering easing monetary policy. And this is kind of in line with what we've been speaking about recently, with inflation being resistant within the markets. We spoke about, especially with oil prices rising, and that's creating an even greater issue for these governments and central banks, as inflation becomes embedded within the economy, with wage creators, employers, foreseeing interest rate rises, and not interest rate rises, sorry, but foreseeing increases in inflation, and as a result, increasing wages before inflation has actually come out. The data to do with inflation has actually come out, and as a result, by increasing people's wages, causing inflation to rise further. And so that's kind of what they're talking about here. Now, and if that inflation does become embedded, although we might see certain falls in certain sectors of inflation data, it is a massive issue for central banks to try and get rid of that resistant inflation and make sure it does not become embedded within the economy. But we'll see how that works out now that Saudi Arabia and Russia are continuing their oil supply cut to drive the oil price to $100 a barrel. Now this speech, this recommendation comes ahead of a crucial central bank set of decisions this week, and that includes the Fed, the Bank of England, Bank of Japan, and we understand that they all have their own different policies, especially with the Bank of Japan, which has an extraordinarily different policy of keeping rates extremely low for a very long period of time. But with the Fed and the Bank of England, we've got a lot to really talk about here, and the Fed is expected to pause rates, and the Bank of England is expected to raise rates. And this is kind of in contrast to what Andrew Bailey has said prior. However, we understand that there are lots of hawkish people within the Monetary Policy Committee in the UK, and so it's easy for us to understand that it's very likely that rates will rise due to resistant inflation within the UK. And the Fed is expected to keep rates at the same level, as we've heard from Jerome Powell and from other members within the Fed. However, certain members are still more hawkish, so we never know. But they also commented on the effects of tighter monetary policy, with business and consumer confidence dropping, as well as China's rebound failing. We've been speaking about China a lot recently in relation to these higher interest rates and how it's really affecting not only their property market, but the wider Chinese economy as a whole and their production sectors. They warned also that where the US has been effective on inflation is it's important that although they've had some success in certain areas, it's important not to celebrate too early. And there's still lots of issues within the US system in relation to inflation, and so you can't declare victory too early. And with the OECD recommending that rates stay the same for the Fed, however, they recommended that the ECB and the Bank of England tighten further. So we understand that OECD is largely a more hawkish institution in terms of its arguments for raising rates further, with central banks such as the ECB and Bank of England. The OECD also forecasted a slowdown in Chinese growth, with the rate falling further below the Beijing's target of about 5% in 2024. And we understand that China's having lots of issues with their growth, as we've spoken about many times, with a 3% drop in domestic spending in China likely also transmitting directly through to trade in Asian economies and commodity exporters. And this is largely the reason why a lot of these Western institutions or Western firms or Western technology manufacturers are trying to divert their supply chains away from China and more towards other areas of the world, especially although staying within the Southeast Asia market. We're talking about Vietnam, where there's been new trade deals developed, as well as new deals developed with India recently. And now the OECD is estimating that a combined Chinese economic and wider financial shock would likely knock more than 1/3 of global growth. And this is largely why these institutions are trying to diversify away from China. But that's all for the articles. Next to talk about is the charts, and we've got lots to talk about on the charts. Less than usual, but still enough to talk about, certainly. And the first being the Nasdaq 100, with the Nasdaq 100 reaching interesting levels here. Now, I kind of commented on these two areas of liquidity that we've recently seen. I said basically I thought it was going to range around here until the Fed interest rate, but turns out, due to data that came out today, we have seen this fall below this liquidity area before it spiked up back off this 61.8% area on the fib, and now it's sitting around this area of consolidation. So it'll be interesting to see whether the Nasdaq 100 how it will react to the Fed's decision, I believe today, as well as the Fed's decision today, as well as any other economic data such as the US mortgage rates data coming out today. So keep your eyes open for that. It will be interesting to see how it will react to that. Now, the dollar is the next to talk about. Obviously, we always talk about the dollar. It's so important to talk about, but with the Fed's decision coming out today, obviously that will have an enormous effect on the dollar. Now, the dollar's kind of been rallying. If we're looking, over a long period of time, the dollar's been rallying since, July 2023, and it's reached interesting levels around this area, with kind of this consolidation, retracement, move higher, consolidation, retracement area, and more recently we've kind of pushed to new highs and then broken back below this prior high made over here in on the 7th of September, and it's broken back below to this area and kind of punched liquidity around the 104.8 area, as well as nearly touching the 61.8% fib. So, it's likely that that's where any institutions got in their orders for the dollar in the lead up to this interest rate decision. But as well as that, to talk about, we've also got the Euro USD pair, and that's especially, important in relation to the Fed's decision today. And it's interesting to see, really, just because we can see where banks have gained their long and short positions in a way to hedge themselves going into the Fed's interest rate decision. And we can see the first area where they've kind of gained buy positions to protect themselves, and this was within this liquidity box which I drew out a while back. And now more recently, yesterday, they gained their short hedges around the 1.07071 area. And so it'll be interesting to see how it will move within this area coming to the Fed's decision today. And finally, to talk about, we have Bitcoin's volatility, and as we can see here, I spoke about yesterday as well how Bitcoin was ranging around this area with liquidity at the top and liquidity at the bottom, how it was kind of false breaking out and moving and staying within this area. But now it does seem like we've broken out and above and punched this liquidity that was created back over here after the SEC's decision. And it's kind of punched up into there twice now, kind of creating almost a double top, even though they're not exact. But it'll be interesting to see whether it will still retrace to maybe another area of liquidity before gaining, long momentum, or in fact it will just, continue to move higher. So keep your eyes open on that. But lastly, to talk about, we obviously have the economic calendar. Now, there's lots happening today on the economic calendar. Firstly, the Japanese balance of trade figures coming out today, along with British inflation data, and that's core inflation plus the normal inflation rate. And that's very key when looking at how the Bank of England will determine its policy, especially in relation to raising rates or lowering rates. Now, we've also got an ECB's official speech, as well as the US 30-year mortgage rates figures coming out, along with the US Fed interest rate decision, along with their economic projections, which are always important to look at the long-term perspective of the economy, along with the Fed's normal press conference, and finally Aussie GDP growth rate. But that's all from me today. Have a great Wednesday trading day. Stay on top of the economic data, stay on top of the news, and make some good trades today. Have a great day. See you later. Bye.